For more on the impact of all the stuff we just talked about and higher yields in the stock market and everything else, let's bring in Andy Constan, the CEO and Chief Investment Officer over at Damp Spring Advisors. Andy, I think you've heard the conversation here. It's an interesting debate that's happening right now. I wonder if you could frame for us what your thoughts are about whether a stock market can continue higher in the face of rising interest rates.
Right. So I think what's happened over the since election has been really a tale of two men, almost a Dr. Jekyll and Mr. Hyde sort of environment, where initially everyone expected, as soon after the election, for President Trump to be Dr. Jekyll like he was in the first term, and markets began pricing that. But after inauguration, Mr. Hyde appeared, and he was quite bad for markets. Since the tariff pause, Dr. Jekyll has come back, and markets have recovered. This chart shows the ratio of stocks to bonds. So when it's rising, stocks are outperforming bonds, and when it's falling, stocks are underperforming bonds. And really, from inauguration to the day that the tariffs were paused, it was bad for stocks, good for bonds. And that's because of the policies. Dr. Jekyll's policies, observable in term one, expected after the election, and certainly last month, were to cut taxes, modestly cut expenditures, allow the deficit to rise, which drives growth, in this environment likely sticky inflation, and also creates supply of bonds. And so Dr. Jekyll measured his success with growth in the economy and rising stock prices. Mr. Hyde was very different and measured success with the 10-year rate. His policies were aggressive deficit reduction via spending cuts and a complete reshaping of global trade via tariffs. Those policies were heavily anti-growth, and Mr. Hyde was great for bonds and bad for stocks. And so,
Andy, I just got a question, though, because in the past, when this has happened, there have been those folks out there who find value in getting a 4.5% yield on a 10-year Treasury or a 5% yield on a 30-year long bond. There is an argument to be made that capital is going to flow because people want to take those yields and take advantage of them. How much is that going to be to the detriment of the stock market?
Yeah, I mean, I think that's the question, which is if we continue on this Dr. Jekyll path, bond yields are going to continue to rise as the deficit rises, as growth rises, as inflation may not have the one-off tariff increase, but may be stickier for longer, keeping the Fed on hold. And so if we continue to have a Dr. Jekyll type environment where the administration pumps stocks and pumps growth, I think long bond yields can rise quite a bit before they start impacting stocks.